Financing new technology ventures in your startup. There are several financing sources available for startup companies and new technology ventures. Here are some of the most common options. 1. Bootstrapping is a common way for entrepreneurs to get their businesses off the ground. This involves using personal savings or funds from friends and family to finance the business. For example, MailChimp was initially funded using credit card debt and personal saving. GoPro's founder Nick Woodman used $235,000 in personal savings and a $35,000 loan from his parents to launch the company. 2. Angel investors. Angel investors are individuals who invest their own money into startups in exchange for equity. For example, Uber received early-stage funding from several angel investors, including first-round capital and lowercase capital. And Airbnb received early-stage funding from several angel investors, including Y Combinator and Sequoia Capital. 3. Venture capital. Venture capitalists invest in startups in exchange for equity and typically provide larger amounts of funding compared to angel investors. For example, Facebook received early-stage funding from several venture capital firms, including Excel Partners and Greylock Partners. Or, SpaceX received early-stage funding from several venture capital firms, including Founders Fund and Draper Fisher Jurvetson. 4. Crowdfunding. Crowdfunding platforms allow startups to raise money from a large group of individuals in exchange for equity, rewards, or pre-orders. For example, Oculus VR raised over $2 million on Kickstarter in 2012 to fund the development of its virtual reality headset. Pebble is another example of using crowdfunding as the financing source. Pebble raised over $10 million on Kickstarter in 2012 to fund the development of its smartwatch. 5. Bank loans. Startups can apply for loans from banks and other financial institutions. However, this may be difficult for new businesses with limited credit history. For example, Kabbage. Kabbage is an online lender that provides loans to small businesses. And Lendio is a platform that connects small businesses with lenders. 6. Grants. There are various government and private organizations that provide grants to startups for research and development, innovation, and other purposes. For small business owners, Small Business Innovation Research (SBIR) grant is an option. The SPIR program provides grants to small businesses to support the research and development of innovative technologies. For medical industry startups, the National Institutes of Health (NIH) grant is an option. The NIH provides grants to support research and development of new medical technologies. 7. Incubators and accelerators. These are organizations that provide funding, mentorship, and resources to startups in exchange for equity. Y Combinator and Techstart are two relatively mature incubators for startup owners to reach out. Y Combinator is a startup accelerator that provides funding and mentorship to early-stage startups. Techstars is a global startup accelerator that provides funding, mentorship, and resources to early-stage startups. Overall, it's important to approach financing with a clear understanding of your goals and needs, and to carefully evaluate any investment offers to ensure they align with your long-term vision for your company. Seeking guidance from a financial advisor or mentor can be helpful in navigating these complex considerations. Moreover, it's important for entrepreneurs to carefully consider the financing costs associated with different types of financing, and to negotiate the terms of their financing arrangements to help minimize expenses. Seeking guidance from a financial advisor or mentor can be helpful in navigating these complex considerations.